Hey guys, today we're going to talk about Brighthouse's SmartCare hybrid long-term care insurance product. I'm with my business partner and cousin Drew. He's over in San Diego. Hey Drew, how's it going?
Hey, Derek, it's going well. Yeah, we're cousins slash business partners here at LTC Tree, and one of Derek's clients just received their Brighthouse statement, and we kind of took apart some of the numbers and wanted to show real world, a real policy, how did it actually perform? These policies have they have a lot of non-guaranteed values on them with Brighthouse in particular. And so when we're talking to clients about this type of policy, I'll usually sort of give them a little bit of a disclaimer that, these numbers could be better or worse than what you're seeing. But let's look at some actual results that happened and compare that with some of the other products on the market. Go ahead, Derek. Tell us what we found out.
Yeah, so just to give a quick summary, in hybrid long-term care insurance benefits, most of the time with most companies, your starting long-term care benefit grows 3% compounded every single policy anniversary date. Brighthouse is one of the companies that has, it's called the index inflation protection. So the net result to the client is going to be a little bit less expensive for you up front, but your future growth is not guaranteed. It's indexed to, in this example, the S&P 500. So we want to just kind of drill down and see, okay, we've had several years of growth. This product's been out since 2016. Let's look at a real policy and see what it went from point A to point B. So we just drilled down on one, and Drew, you want to go over the detail of the data we saw?
Yeah, absolutely. So just one quick story about Brighthouse in particular. It comes up a lot with my clients when they care about international benefits in particular. Brighthouse has one of the more liberal international benefits. So yesterday I had a Zoom call with a client out of New Jersey who is actually thinking about retiring possibly in Kenya. I hadn't had one like that before. And we were looking at Brighthouse versus a couple of the other competitors in the market for a hybrid plan. He's in his 40s, by the way, late 40s. People always ask when's the best time to buy this. Well, people are looking at it in their 40s. But we zeroed in on Brighthouse. But I was talking to him saying, the thing is, we don't know how much your policy is going to grow over time because it's indexed to the S&P. Now, there's a lot of complicated moving parts with these indexes. So I figured there'd be no better way to illustrate how it actually performed in the first year of a policy than to show real numbers. So that's what we're looking at here. Can you see this chart, Derek?
I can, yeah, I sure can.
Okay, so while I've been talking, everybody's probably been taking a look at these numbers. So his original benefit, this particular client, this is a real client with a real policy, was at $6,700. I'm just rounding here, $6,697 upon issue of the policy. On the first policy anniversary, he got $7,160. So his monthly benefit has grown from $6,700 to $7,160. And if he had had a 3% compound, which Brighthouse doesn't even offer, but let's just compare it to, let's say a plan did offer 3% compound, which most companies do, he would have only grown from 66.97 to 68.99. So in the last year, that S&P indexing has dramatically outpaced the 3% compound. And that's sort of the point we're trying to make here.
Yeah, so with Brighthouse, it's not guaranteed to grow at all. So that's kind of the trade-off. But it's also, you have a shot at getting a higher growth than 3%. In this case, first year in, he got a much higher growth than the 3% compound. So as we were talking about off camera, if you can bank a couple big years in the first few years, that really increases your money because you're getting compound interest on top of interest. That'll set your account off to be outpacing the peers, the other companies we work with that are just going to get 3%, over the next 20 years, and you should have a much higher growth in your benefits at that point.
Yeah, exactly. And just so people say, well, they're probably going to have to eat their hat next year when the market's down and the benefits crash back down. That's not how it works. So once you have clicked up to the new level, if the market's down, sideways, or even modestly up, you will not see any growth. So we have to have some pretty solid S&P growth to get these kind of results. because this has a 9.5% cap rate. So let's explain that just a minute.
Yeah, the cap rate, this maxed out as a 9 point. So the S&P was up 20% last year, call it. This capped out at 9.5%. So inside that captured interest rate that they got, they still have to pay the existing life insurance charge, because obviously if this gentleman dies in his sleep and never uses it, a big life insurance policy is going to be paid to his family. So they use part of the growth of that 9.5 to pay for the life insurance expense. The other part goes towards the inflation that Drew just discussed. And then there's also ongoing internal fees. So the net for him was he got about a $400 increase per month in his monthly benefit for the long-term care. And I think we saw his life insurance grew slightly as well.
Yeah, his life insurance went up just a tad, and he actually exceeded what was on the illustration that you had given him when you sold this to him more than a year ago. This is a breakdown of inside of the policy, how different things moved around and so forth, rider charges and so forth. Then, like you say, the net is he paid no additional premium and got those benefits. And every year is going to be a little bit different with all these adjustments inside the policy. It's completely irrelevant to the actual benefits that he has with regards to how that works. So the other thing to know about Brighthouse is that cap rate currently at 9.5%, it can be adjusted downward. And the mechanism upon which that can happen has to do with current prevailing interest rates and things like that. So it's really hard to predict how well one of these is going to perform. But what we've seen is that in the first couple of years of these policies, they seem to be doing very well. And that's on top of the fact that when you're comparing side by side with other hybrid companies, Brighthouse often has a higher initial benefit amount when we use this indexed inflation. So your base is higher. In your first couple of years, your growth is higher. It's really a solid proposition so far from what we're seeing.
Yeah, so we just want to jump on today, do a quick video, just kind of give you a little inside information on how these inflation protections works with Brighthouse. But we're LTC Tree. We work with all these companies. We're happy to compare all the products with you, including Brighthouse. Now, and we'll go over the pros and cons of each. Like, one of the pros you said, Brighthouse has the best international benefits. You can use the plan anywhere in the world, paid in cash. Whereas some companies, they offer a 50 or no elimination period. There's no 90-day waiting period. So we'll go over the pros and cons of each product. And yeah, Drew, if you got anything else to add, that's all we got for today.
And I guess one thought that comes to my mind, I feel like we're shilling this particular product, which is not true at all. In fact, this isn't even the most popular product we sell. This is one of the top ones, but it's definitely not the top one. We work with all the companies that are major players in this industry. We like to show each client what is best for their particular situation. So if you feel like you're getting a runaround from a financial advisor or somebody else like that, who is just showing you one product and you want to see kind of a side-by-side comparison of multiple ones, that's our secret sauce. And I'll just wrap up. So the total benefit that this particular policy got, and he started off with $100,000 premium a year ago. He now has $343,000 in long-term care benefits off that $100,000 premium in just 1 year. So it's an impressive growth rate whenever the S&P is doing well. It's a good policy to have.
Yeah, great. Well, hey, thanks for grabbing that data, Drew. And guys, if you want more information, click on the link below to fill in your information or call us. We'll be here. Happy to answer any questions you might have.
Yep. We'll catch you later.